Welcome back to the channel. Today, we've got a huge one for you. Dan Ives, the global head of tech research at Wedbush, just went on CNBC and dropped some bold takes on the state of big tech. He said, and I quote, "Clock struck midnight for Apple." According to him, Apple is watching the AI revolution from the sidelines, while companies like Microsoft and Amazon are charging ahead. And speaking of Amazon, he also called this moment the renaissance of growth for the company. So whether you're bullish on tech or just trying to figure out where the real opportunities are in this AI-driven market, this is the interview you need to hear. I'm going to play you the clip of Dan Ives in just a second. Right after that, I'll give you my full breakdown, my take on what he said, what he really meant, and why it matters. Then, I'll break down what I believe are the 3 best tech stocks to buy right now, based on this evolving AI narrative. So if you're only going to watch one video today, make it this one. And stick around till the very end. Hit that like button. Let's see if we can hit 1,000 likes on this one, and share this with someone watching Apple or Amazon closely. Drop your thoughts in the comments, and of course, subscribe if you haven't already, so you don't miss the next major investing update. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. All right, let's roll the clip. Here's Dan Ives on CNBC.
Dan, it's good to see you.
Great to be here.
So what happened with Amazon?
I mean, look, I view it as an overreaction. I mean, to me, if you look at AWS, strong. You look at ultimately guidance. I mean, guidance from a top-line perspective, I view as pretty robust. I mean, I actually believe this is sort of the renaissance of growth that's about to happen at Amazon. I think, look, you're just seeing investors hypersensitive, but you look at overall big tech earnings, monster results from the 𝗗𝗟𝗏𝗧 of tech, Microsoft. You look at what we saw from Meta, and even when you look at Apple, I mean, I think there's a big tech.
Although the market response to at least not Meta, but the other 3, I mean, Apple's down. Mm-hmm. Obviously, Amazon, the worries about the guidance, 17.5% growth at AWS, but far less growth than Azure, for example. Microsoft shares did not perform particularly well either after a very strong quarter. Yeah. Concerning to you?
I mean, to me, I think it's just the beginning. I mean, look, we think Microsoft's going to be a $5 trillion market cap in 2026. And then when I look at what Endava is doing in terms of the cloud strategy, I mean, those are Azure numbers that were beyond bull case. And I think ultimately investors, they're going to continue to try to find negatives here. But when you think about the big tech growth story and the AI revolution, I mean, this is just the next phase of growth that's now going to the second, third, fourth derivative. Apple being in another category, because right now they're essentially on a park bench drinking lemonade, watching the AI revolution go forward.
Yeah, is that why the stock? I mean, that said, they're also not spending the money that their so-called competitors are at all. They're nowhere near that on capex. But the stock down. Now, granted, we've been talking about the macro reasons today. But you would have expected, with 13% growth of iPhone sales, that the stock would be up.
Look, it was a robust quarter. I mean, you look at the demand bounce back that we saw in China, 4% growth. iPhone demand that's actually going to show growth into the next few quarters. But the elephant in the room is AI. Because the reality is, like, if you look at WWDC where we were, that was a back to the future, right? In other words, like, they're years behind. Investors want to see them now change the status quo. They're on the treadmill. We've talked about it. Kramer's talked about it. I mean, Perplexity is the no-brainer deal. Because the reality is they're not going to have AI innovation that's going to come internally at Apple Park.
You think the market would applaud that?
I believe that would be not just a game changer. I think it would change the trajectory for Cook and Cupertino, because right now, this is the biggest tech trend in the last 40, 50 years. And when you look at what we're seeing with this arms race, from Meta to Microsoft to Palantir, and of course led by Godfather of AI, Jensen, NVIDIA, we're seeing the use cases. We're seeing an enterprise. And for Apple, you can't be on the outside looking in, and that's why I believe clock struck midnight. It's time for them to actually change.
You've always liked it.
Cook kind of... Jim Cramer spoke to him. I don't know if you saw it. We highlighted it earlier on the show. I mean, his language did seem to change a bit around M&A.
Yeah, I think there is a look, and as we've talked about, I mean, besides Beats, and you've talked about it.
Beats is the largest deal they ever did. $3 billion.
Yeah. Exactly. But now they need to change because they recognize that the innovation's not going to happen internally. And their hands are tied, too, when it comes to DOJ and what they could do with Google and some of the other partnerships. I believe they're going to have to do not just one, but multiple deals. And that's our view. But I think if you take a step back in big tech earnings, and obviously a down day today, you feel more bullish about going into the rest of the year, which is why we believe we're going to be looking at NASDAQ 22, 23,000, and into next year, another 10 to 15%.
You feel more bullish. Yeah.
I feel more bullish because of the underlying growth in the AI revolution.
All right, Dan, thank you.
All right, so Dan Ives kicks off with Amazon, and his take is pretty contrarian right off the bat. While the market reacted negatively to Amazon's weaker profit guidance, Dan is basically saying, calm down, this is an overreaction. He points out that AWS, Amazon Web Services, is still strong with 17.5% growth, and that the top-line revenue guidance wasn't weak at all. In fact, he frames it as the beginning of a new growth cycle for Amazon. So the key message here, investors are being hypersensitive right now. Any sign of weakness, even if it's short-term, is triggering pullbacks. But according to Ives, this moment for Amazon might actually be the early innings of a renaissance in growth. That's a bold statement, but he's clearly implying that AWS is stabilizing and potentially ramping back up, something that's crucial given how dominant cloud computing is to Amazon's overall narrative. Then he pivots to Microsoft and brings up a metaphor I loved. He calls Microsoft the Scotty Scheffler of tech. In other words, consistent, dominant, and always delivering. Despite that, he acknowledges that even Microsoft's stock didn't perform well post-earnings. And this is where things get interesting. He says the Azure numbers were beyond the bull case, but even that wasn't enough for the market. So what gives? Ives is essentially saying that we're entering a phase where investors are desperate to find something wrong. He sees it as more of a market psychology issue than a fundamental one. He's not backing down on his long-term bullish thesis. In fact, he says he still sees Microsoft hitting a $5 trillion market cap by 2026. That's massive conviction. Now let's talk about Apple, because this is where Ives starts dropping some heavier criticisms. He compares Apple to someone sitting on a park bench sipping lemonade while the AI revolution passes them by. That's not a flattering image. He's basically saying that while Apple had a solid quarter, 13% iPhone sales growth, 4% growth in China, it's all being overshadowed by the fact that Apple is behind in AI. He references WWDC and calls it a back-to-the-future moment, suggesting Apple is years behind its peers in AI integration. And this leads us to one of the most important parts of the interview, the discussion on M&A, mergers and acquisitions. Ives strongly believes Apple needs to stop trying to innovate from within and start acquiring their way into the AI race. He brings up Perplexity AI as a no-brainer acquisition, something that would instantly give Apple some relevance in the space. Here's the crucial takeaway. Ives is arguing that Apple's internal innovation engine has stalled when it comes to AI, and unless they pivot hard through M&A, they risk being completely left behind. He even calls it clock striking midnight for Apple, a way of saying that time is up and they need to act fast. Then, the host brings up that Tim Cook's language around M&A has started to shift, referencing a recent Jim Cramer interview. And Dan Ives agrees. He sees this as a signal that Apple knows they need to change course. Historically, Apple's biggest acquisition was Beats for $3 billion, which is tiny compared to what Microsoft, Meta, or even Amazon are doing in this AI arms race. And then Ives goes even further. He says Apple won't be able to pull off just one deal. They're going to need to do multiple acquisitions to catch up. And they might be forced to, because of limitations from DOJ pressure, and their reliance on partnerships with companies like Google. In other words, they've boxed themselves in and now need to buy their way out. Finally, Dan wraps the interview with his broader market view. Despite the sell-off in tech stocks that day, he says he's more bullish now than ever. He's forecasting a potential 10-15% gain in the NASDAQ heading into 2025, targeting a level around 22,000 to 23,000. That's a strong call, and it underscores his thesis. The AI revolution is real, and it's still in the early innings. So here's the bottom line. Dan Ives sees the current market turbulence as noise, an emotional overreaction to short-term guidance misses. Underneath all that, he believes the long-term AI-driven growth cycle is just getting started. Amazon's fine, Microsoft's killing it. Apple's at a crossroads, and the next move they make could either reinvigorate their innovation machine or leave them watching from the sidelines as the rest of big tech pulls away. If you're an investor, this is the time to start paying attention to strategy, not just numbers. Are these companies positioned to lead the AI era, or are they lagging? Because that's going to define the next decade in tech. Let me know what you think in the comments, especially about Apple. Should they go on an AI shopping spree or try to build it all themselves? I'd love to hear your take. And if you found this breakdown helpful, don't forget to like, subscribe, and hit that notification bell so you never miss an update. Now let's dive into the 3 best tech stocks to buy right now based on this evolving AI narrative. Let's start with Endava, ticker DAVA. a digital transformation powerhouse that's quietly reshaping how the world's biggest companies operate in the digital age. While you might not see their name splashed across headlines every day, their impact is felt in the core systems of industries that touch our daily lives. This is a company you won't hear hyped on mainstream news or see trending on social media, but that's exactly what makes it such an intriguing opportunity for savvy investors. Endava specializes in helping global giants modernize their technology infrastructure. Whether it's streamlining payment systems, enhancing media platforms, or building secure, scalable cloud solutions, Endava embeds expert teams directly into client organizations to deliver custom, next-generation solutions that drive real business value. Their unique nearshore delivery model, with innovation centers in Central Europe and Latin America, gives them access to top-tier technical talent at competitive costs. This setup allows for real-time collaboration with clients in the US and Europe, bridging time zones and cultures to deliver seamless project execution. By working closely with clients over the long term, Endava builds deep, strategic partnerships. This approach leads to sticky, recurring revenue streams, as clients come to rely on Endava not just for one-off projects, but as a trusted advisor and ongoing technology partner. Their client roster reads like a who's who of industry titans, major banks, global insurers, and leading media conglomerates. These are organizations with complex ongoing technology needs and the budgets to match, ensuring a steady pipeline of work for Endava's teams. Endava's reputation for delivering successful high-impact projects is its strongest marketing tool. Satisfied clients become repeat customers and often refer new business, fueling organic growth without the need for splashy ad campaigns. Financially, Endava has been nothing short of a growth machine. For years they've posted strong double-digit revenue growth, consistently outperforming many of their peers in the IT services sector. Their disciplined approach to cost management and focus on high-value projects has translated into robust margins and healthy cash flow. Of course, no company is immune to broader economic forces. Recent macro headwinds like global economic uncertainty and shifting client budgets have pressured Endava's stock price. But the underlying demand for digital transformation is only accelerating, especially as artificial intelligence and emerging technologies become mission-critical for businesses everywhere. The current slowdown in project starts is cyclical, not structural. As the economic environment stabilizes, companies will have no choice but to restart and even accelerate their tech initiatives to stay competitive in a rapidly evolving landscape. The market's short-term focus on quarterly results has created a rare buying opportunity for long-term investors who can see past the noise and recognize the enduring value of Endava's business model. Endava's balance sheet is rock solid. With healthy cash reserves and minimal debt, the company has the flexibility to invest in new growth areas, weather downturns, and even pursue strategic acquisitions if the right opportunities arise. The company is founder-led, with CEO 𝗗𝗟𝗧 at the helm since its inception. His clear vision and steady leadership have guided Endava through multiple growth phases, ensuring the company stays true to its core values while adapting to new market realities. Endava is not standing still. They're actively expanding into high-growth areas like data analytics, artificial intelligence, cloud computing, and digital payments, constantly evolving their offerings to anticipate and meet the future needs of their clients. The digital transformation market is absolutely massive, and despite their impressive growth, Endava still commands only a small share. This leaves enormous room for expansion as more companies embark on their own digital journeys. Their land and expand strategy is a proven winner, starting with a single project and then growing their footprint within existing clients. This not only drives profitability, but also deepens relationships, making Endava an indispensable partner. High client satisfaction and sticky long-term partnerships are the fuel for Endava's growth engine. Their ability to retain and grow accounts is a testament to the quality and impact of their work. The disconnect between Endava's current stock price and its long-term intrinsic value is a textbook example of a value investing opportunity. When the market underestimates a company's future potential, patient investors can benefit. With a market cap of just over $706 million, Endava generated $740.76 million in revenue for 2024, posting a net income of $17.12 million. That brings its earnings per share to 32 cents. And, while the P/E ratio sits relatively high at 37.31, suggesting growth expectations, the real story here is the valuation gap. Shares are currently trading at just $11.94, which is a staggering 85.68% below its estimated fair value of $22.17. That kind of disconnect raises eyebrows, especially if the business can stabilize and return to stronger margins in the coming quarters. Endava's fundamentals remain strong. The need for their services is only growing, and their competitive moat, built on talent, client relationships, and technical expertise, is deep and defensible. For patient investors, this recent pullback in the stock price represents a fantastic entry point into a company with a bright future. Buying high-quality companies when they're temporarily out of favor is how long-term wealth is built. It's about seeing the forest for the trees and trusting in the underlying business. Endava's proactive approach to innovation and its strong, visionary leadership ensure the company will remain at the forefront of digital transformation for years to come. Their ongoing expansion into AI and cloud services positions them perfectly for the next wave of technological innovation, opening up new revenue streams and strengthening their competitive edge. Remember, the market's fear is often your opportunity. Endava's long-term growth story is just getting started, and those who act now could be rewarded as the company continues to execute. Don't let the short-term noise and volatility distract you from the durable potential that Endava offers. Staying focused on fundamentals is key. Endava is a rare chance to buy a future tech leader at a discount, a company with the vision, leadership, and financial strength to thrive in the digital era. Keep this one on your radar, and consider whether it deserves a place in your long-term portfolio. Now, let's move to our next pick and see what other opportunities the market has in store. Next up is Akamai, ticker AKAM, the invisible backbone of the internet. While you may not see their name every day, Akamai is quietly powering much of the digital world behind the scenes. Their technology is woven into the fabric of our online lives, making them one of the most important yet underappreciated tech companies out there. If you've streamed a movie, binge-watched your favorite series, or shopped online for anything from groceries to gadgets, chances are you've relied on Akamai's services, often without even realizing it. Their technology ensures that your content loads quickly, your transactions are secure, and your experience is seamless, no matter where you are in the world. Akamai's Global Content Delivery Network, or CDN, is the engine that makes streaming, fast web browsing, and real-time online experiences possible. With thousands of servers distributed across the globe, Akamai handles a massive share of the world's internet traffic every single day. Their infrastructure is so vast and complex that it's become a critical part of how the internet functions. Their scale is a massive barrier to entry. No one can easily replicate their infrastructure. Building a network of this size and reliability would take years and billions of dollars, making Akamai's position in the market incredibly defensible. But Akamai isn't just a CDN company anymore. Over the past decade, they've evolved far beyond their roots, transforming into a multifaceted technology powerhouse. They've leveraged their global network to build two high-growth businesses, cybersecurity and edge cloud computing. By using their existing infrastructure as a foundation, Akamai has been able to expand into these lucrative markets with speed and efficiency. Their security solutions are designed to stop cyber attacks before they ever reach customers, making Akamai mission-critical for any business that operates online. In a world where cyber threats are growing more sophisticated by the day, Akamai's ability to detect and neutralize attacks in real time is invaluable. This security segment is growing fast and carries higher margins than their legacy CDN business. As more companies move online and the threat landscape evolves, demand for Akamai's security offerings continues to surge, driving both revenue and profitability. Akamai's edge computing brings processing power closer to users, crucial for gaming, IoT, and real-time AI. By processing data at the edge of the network, Akamai reduces latency and enables new applications that simply weren't possible before, from immersive gaming to smart cities and autonomous vehicles. Their acquisition of Linode accelerates this strategy, letting them offer integrated content delivery, security, and edge computing from a single platform. This move positions Akamai as a one-stop shop for businesses looking to build, secure, and scale their digital operations. Financially, Akamai is highly profitable, generating strong free cash flow and investing aggressively in growth. Their disciplined approach to capital allocation means they can fund innovation while still rewarding shareholders. The market has punished the stock for short-term CDN softness, ignoring the booming security and cloud segments. This disconnect between perception and reality has created a rare window of opportunity for forward-thinking investors. This creates a compelling opportunity. Akamai is valued like a utility, but its growth engines are just revving up. While the market sees a mature, slow-growth company, the reality is that Akamai is transforming into a high-growth tech leader. Their moat isn't just infrastructure, it's data. By seeing so much of the world's internet traffic, Akamai gains unique insight into emerging threats and trends. This data advantage allows them to make their security products smarter and more effective over time, creating a virtuous cycle of improvement. The more customers they have, the better their products get, a powerful flywheel effect. As their network grows, so does their ability to protect, accelerate, and innovate for their clients. CEO Dr. 𝗗𝗓 𝗧, a co-founder and algorithm expert, has guided Akamai's evolution for decades. His vision and technical expertise have kept the company at the forefront of internet innovation, ensuring Akamai adapts to new challenges and opportunities. You get a stable, cash cow legacy business plus 2 high-growth engines in cybersecurity and cloud. This unique combination offers both safety and upside, a rare find in today's tech landscape. The market is stuck on yesterday's story, but the future is all about security and edge computing. As digital threats multiply and demand for low-latency applications explodes, Akamai is perfectly positioned to lead the next wave of internet innovation. As these segments grow, Akamai's overall growth rate will accelerate, and the market will have to catch up. When that happens, today's undervaluation could look like a bargain in hindsight. Their integrated platform creates a sticky ecosystem for customers, making it hard for businesses to switch away once they're plugged in. This customer loyalty further strengthens Akamai's competitive position. With a market cap of $11.09 billion, Akamai has long been a backbone for secure content delivery and edge computing. For 2024, the company posted $3.99 billion in revenue and an impressive $504.92 million in net income, with an earnings per share of $3. Despite a solid P/E ratio of 24.79, the stock currently trades at $74.38, well below its fair value estimate of $108.48, a 45.85% discount. For a company this stable and profitable, that's a sizable gap, and it could present an appealing entry point for investors looking for undervalued large-cap tech. Akamai's transformation is underappreciated. Smart investors see the disconnect. They recognize that Akamai is no longer just a CDN provider, but a diversified tech leader with multiple growth levers. Investing now is a bet on the future of a fast, secure internet. As our reliance on digital services grows, so does the need for Akamai's solutions. Few companies are as critical to the digital world as Akamai. Their technology touches billions of people every day, often without them even knowing it. The opportunity is clear. Buy before the market wakes up. This is a chance to invest in a company at the heart of the internet's future before the rest of the world catches on. Let's move to our final pick. Ready for the next tech enabler? Here it is. Our third pick is Sensata Technologies, ticker ST, a true pioneer in the world of sensor technology, quietly powering the physical world all around us. While you may not see their name on consumer products, Sensata's innovations are embedded in the very fabric of modern life, making them an essential but often overlooked force in the tech ecosystem. Sensata designs and manufactures a vast array of sensors, switches, and controllers, the nervous system of modern machines. These components are the unsung heroes that allow everything from cars to industrial robots to operate safely, efficiently, and intelligently. In the automotive world, their sensors monitor everything from tire pressure to engine temperature, playing a critical role in both safety and efficiency. Without these sensors, drivers would be left in the dark about vital vehicle functions, and automakers would struggle to meet today's demanding safety and emissions standards. The ongoing shift to electric vehicles, EVs, and automation is a game changer. Each new EV requires even more sensors than traditional cars, monitoring battery health, managing power flow, and ensuring safe operation. As a result, Sensata's content per car is set to soar, positioning them at the heart of the transportation revolution. They supply essential components for EVs, like high-voltage contactors and battery sensors, making them a key player in the electrification trend. These parts are mission-critical, ensuring that electric vehicles run smoothly, safely, and reliably, qualities that are non-negotiable as the world transitions away from fossil fuels. Automation and autonomous driving require even more sophisticated sensors, ones that can detect, analyze, and respond to the environment in real time. Sensata's expertise in developing these advanced solutions is foundational, giving them a front-row seat as vehicles become smarter and more autonomous. But Sensata's reach goes far beyond automotive. Their sensors are used in aerospace, heavy vehicles, and industrial automation, where reliability and precision are paramount. From monitoring aircraft systems at 30,000 feet to keeping massive construction equipment running, Sensata's technology is everywhere. In factories, Sensata's rugged sensors enable the industrial Internet of Things, driving efficiency, reliability, and predictive maintenance. These sensors help manufacturers avoid costly downtime and optimize every aspect of production, making them indispensable in the age of smart manufacturing. This broad diversification cushions Sensata from downturns in any single market. Whether it's automotive, aerospace, or industrial, their presence across multiple sectors provides stability and resilience, even when one industry faces headwinds. Sensata's competitive moat is built on deep engineering expertise and long-term customer relationships. Once their sensor is designed into a product, switching to a competitor is costly, time-consuming, and risky, making Sensata a trusted partner for the world's leading manufacturers. This creates sticky, recurring revenue streams that provide predictability and financial strength. As their customers grow, so does Sensata, creating a virtuous cycle of innovation and profitability. Financially, Sensata generates strong cash flow and is laser-focused on margin improvement and debt reduction. Their disciplined approach to capital allocation means they're well-positioned to weather economic storms and invest in future growth. The stock has been pressured by short-term worries about China and the pace of EV adoption. These concerns have created volatility, but they don't change the company's long-term trajectory or the fundamental demand for its products. The long-term trends, electrification, automation, and industrial IoT, are unstoppable. As the world becomes more connected and intelligent, the need for Sensata's technology will only accelerate. Sensata is a classic picks and shovels play on these megatrends, supplying critical components to nearly every major player in the industries driving tomorrow's economy. They don't compete with the end brands, they empower them. Recent smart acquisitions like GigaVac have further strengthened their position in electrification, expanding their portfolio and deepening their expertise in high-growth markets. Management is experienced, focused on operational excellence and building for the future. Their strategic vision and disciplined execution have positioned Sensata as a leader in a rapidly evolving landscape. The market is often distracted by cyclical noise and short-term headlines, but Sensata's long-term growth drivers are just getting started. The real story is unfolding beneath the surface. For patient investors, this is a rare chance to buy the nervous system of the future at a discount. As technology advances, Sensata's role will only become more vital, making this an attractive entry point for those with a long-term mindset. Sensata is deeply embedded in the infrastructure of our modern economy, from smart cities and power grids to transportation networks and industrial facilities. Their technology is the invisible thread connecting and optimizing these complex systems. Their role in electrification and automation will only grow as industries demand more intelligence, safety, and efficiency from their machines and infrastructure. The market is underestimating their potential. Don't make the same mistake. Sensata's story is one of quiet dominance, and those who recognize it early stand to benefit the most. Sensata Technologies has a market cap of $4.5 billion and a 2024 revenue of $3.93 billion. Net income came in at $128.48 million, translating to earnings per share of 75 cents. The current PE ratio stands at 39.91, which on the surface may seem steep, but again, it's all about the delta between price and value. Shares are trading at $29.93, which is nearly 40% below the fair value of $41.80. That kind of valuation gap suggests the market might be underestimating Sensata's longer-term growth, or its potential to re-rate as margins expand. This is a long-term play for those who see where technology is headed. If you believe in the future of electrification, automation, and smart infrastructure, Sensata deserves a place in your portfolio. Sensata is a smart, diversified bet on the future of tech, one that combines stability, innovation, and exposure to multiple high-growth markets. Keep this one on your watch list, and consider it as a core holding for the next decade of technological transformation. Let's wrap up with your next move, because in a world that's getting smarter, investing in the companies that make it possible is the smartest move you can make. Here's how to take action and position yourself for the future with Sensata Technologies. There you have it, Endava, Akamai, and Sensata, 3 tech leaders quietly powering the future. Each is a leader in its field, with strong moats and undervalued long-term potential. The market's short-term focus is your window to invest in these future giants. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. But this isn't just theory. You'll learn how to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments no matter what the market throws at you. Whether you're just starting out or want to sharpen your strategy, this course gives you the tools and confidence to grow real, long-term wealth. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Trust me, your future self will thank you. For exclusive tips and deep dives, join the Stocks Galore Patreon community. Which of these stocks excites you most? Let me know in the comments, and don't forget to like, share, and subscribe for more. Thanks for watching. See you in the next one.